Okay, in question number 11, examiner says, when will a cartel find it most difficult to fix market price of its product? Cartel is basically the hidden agreement between firms, and it will be ineffective to fix prices when proportion of firms in the industry that are member of cartel is definitely low. So option C and D can be correct answer. We can exclude it. Barriers of entry into the industry is must be low, mean there is freedom of entry and exit. New firms can easily enter the industry. So again, cartel will be ineffective because new firms will be continuously entering the industry. So D is correct answer. Question number 12 says the diagram shows the cost and revenue curves of a monopoly. What is the firm's objective if it produces output OX? This is output X. And you can see that when output X is produced, marginal revenue is zero. Okay? And when marginal revenue is zero, total revenue is maximized. So the condition is total revenue maximization condition is marginal revenue must be equal to zero. It means when you sell one additional unit, you get no additional revenue because revenue has already reached maximum level. And at this point, price elasticity of demand is equal to 1. So this is basically these are the conditions for revenue maximization. So at point X, marginal revenue is 0. And if we draw perpendicular till average revenue, which is also demand curve, then price charged is P, and this price P will maximize total revenue. And at this point, elasticity of demand is equal to 1. Before this, elasticity will be greater than 1. After this, elasticity will be lesser than 1. So in question number 13, examiner says which policy is not designed to correct market failure? Market failure exists whenever there is inequality of more marginal social benefits and marginal social cost. So if we are producing at point this, and this is the cost and benefits which are equal, then it is successful market and it is optimum level of output. But if we are producing more than Q, then it will cause deadweight loss and result in market failure. And if we produce less than this, again it will cause deadweight loss and market failure. So which policy is not designed to correct market failure? All other policies are designed to correct market failure apart from uh, option D, removing import quotas. If you are removing import quotas, then it will not correct market failure. All other policies will correct it. Like provision of healthcare by the government, definitely under production will be removed. And price controls on large firms, again, monopolies are controlled. Regulation is again a very good source of correcting market failure. So D is correct answer. Question
Yes.
says a chemical firm produces toxic fume that impose cost on society. The diagram shows the free market equilibrium of the firm's product at P1Q1. It means we are already operating at this point where output is Q1 and price is P1. And at this point you can see that marginal private cost is equal to marginal private benefit. The government imposes a tax on the firm of X, Y. Government imposes this much amount of tax, then it resulted in rise in price to P2 and fall in quantity to Q2. How would this improve resource allocation? Means how the act of imposing taxes will improve resource allocation. Resource allocation is definitely improved when marginal social cost and marginal social benefits are equal. So if government internalizes the external cost, then it will definitely reduce negative externalities and it will reduce the production of toxic fumes. Internalization of external cost is cost to the third party, and internal cost is private cost. When you impose taxes on private producers, then it means you are basically converting external cost into internal cost into private cost. So this will definitely help to achieve resource allocation, better resource allocation. In question number 15, the level of benefit paid to an individual receiving means tested benefit depends on the individual's income. So the correct answer for 15 is C, that is income. Mean tested benefits are the benefits provided by the government to those whose earning is below a certain threshold. So mean tested benefits are based on basically the level of income individuals are earning. Another benefit, financial benefit, which is generally given by the government, is known as universal benefit. Universal benefits are the benefits to given to everyone who comes under a certain category. For example, a person retired from army will receive pension uh, for his entire life, and this pension is given to him not because he is a poor person, because he comes under rather he comes under certain category, so he receives that pension payment. So mean tested benefits are based on income. Those receive mean tested benefits whose income is below certain threshold, like the poor class. Question number 16 says the diagram shows two Lorentz curves. The one is L1 and the other one is L2. The concept of Lorentz curve is that if we go away from 45-degree line, it means it increases disparities, which is income gap between rich and poor. If we are going away from this 45-degree line, it means the income gap between rich and poor is increasing. So keep in mind, L1 shows less disparities and L2 shows greater disparities, and this 45-degree line shows no disparity, which is in reality not possible. If Lorentz curve shifts from L1 to L2, what is least likely to have caused this? So if we are going away, then least likely cause is progressive income tax. If income tax has been made progressive, progressive income tax is when income increases, tax rate also increases. And it is also known as automatic stabilizer. If government uses automatic stabilizer or uses progressive tax, then disparities must have decreased. So this action is least likely to cause this. In question number 17, examiner says a firm is operating in perfectly competitive market. And perfectly competitive market is the market where there are large number of sellers, prices are same, and entry and exit is free. So in this scenario, price is equal to average revenue is equal to marginal revenue. Because price remains constant, everyone charges same price. So price, average revenue, and marginal revenue, all three variables are equal or same. Why does the marginal revenue product of a factor of production employed by the firm fall as more of the factor is employed? If we apply formula of marginal revenue product of labor, marginal revenue product of labor is equal to marginal physical product of labor into price. So examiner says that marginal revenue product is falling. If left hand side is decreasing, mean marginal revenue product is decreasing, and we know that in perfectly competitive market there is no change in price. It means right hand side there are two variables, MPPL and P. P cannot change because it remains fixed. So only variable that can result this decrease in marginal revenue product is marginal physical product of labor. If marginal physical product of labor falls, then definitely uh, marginal revenue product will also fall. So B is the correct answer.